Folks, Bob Desmond here at the Contrarian Trader, and it is around 2 o'clock in the morning, Thursday, the 29th of November, and I figured since I can't sleep, I'll do a video with regard to natural gas and how I do a top-down approach to my analysis of trades or potential trades that have been in a long-term secular bear market. And if you go back using a monthly chart, you could see that we peaked out back in June of 2008. Can you believe that? And then we broke down below support in September 2008, and that began a bear market, which technically has not ended yet. It may look as though it has ended, but it hasn't yet. So we're going to walk through what we're looking for here before we call an end to the bear market in natural gas. Let's annotate this chart. We'll spend more time on a weekly chart than on a monthly chart, but it's worth going over because these are the signals by the market that have us curious as to whether or not this is a potential trade. And have we seen a bottom in natural gas? And you'll hear a lot about there's a glut of natural gas, yada, yada, yada. They've known about a glut in natural gas way back here. This is why you had a bear market. So for those people who are so concerned about a glut of natural gas in a bear market, get over it because it's been a well-known factor for a long, long time. It's old news. The question you should be asking yourself, due to the fact that the markets are a forward-looking indicator, is as to why. Why now is natural gas beginning to break out? So here you have it. Here's our long-term upper band of resistance in a bear market. We had an initial bottom back here in March of 2016. We rallied up to 39.94. And that was a very nice rally. And one might have thought that that was the top, but we didn't retest the lows yet. So we pulled back and we actually failed to hold this prior low. We broke it and we broke down significantly below that low. And this is what you call an undercut double bottom on UNG. Now, it's only an undercut double bottom if this breakdown fails, as it did here, because we broke down December of 2017, hit a low of $20.40, but we reversed to close higher on the month at $23.32. Where does that put us? It puts us back above the prior low. So despite the fact that it was a down month, this was a very bullish month because, again, we took out all the stops that were placed below 23.12 and they reversed it. And they closed it back above 23.12. Yes, still down on the month. Let's get over that. It's the price action that matters. So what happened subsequent to that? We went into a trading range. This hurt confidence of shorts. They weren't as willing as in the past to go shorting natural gas willy-nilly because all of a sudden there were signals by the market that there were buyers out there. Now, fast forward after this consolidation, a multi-month consolidation, we broke out above resistance back in August. We pulled back and we did a retest of support, much as what we did back here when we broke out in December of 2016. We pulled back to the retest in April, and then several times thereafter, and finally a retest back in December. So we retested this support level. After that retest, it was off to the races. So now on a monthly basis, we are trading above the 2 standard deviation Bollinger Band in green and the 3 standard deviation Bollinger Band in red. In short, it's a bit extended here. We are at current trading above the 50-period moving average. So despite the fact that we are a bit extended, that does not mean that we cannot proceed higher because there are plenty of shorts to still get squeezed and fuel a short covering rally higher. I spelled monthly wrong. So let's go to a weekly chart. So on a weekly basis, we became very extended back here, the week of November the 25th. In fact, we shorted natural gas using the DGAZ. We shorted it here on November the 10th, and then we booked profits here on November the 15th. That was a 28% profit within one trading day. So it was a nice trade. But it was an easy trade to do. And we'll go over the daily chart and I'll explain why in a moment. Back to the weekly chart. So ever since that point in time, we had put in a topping tail, wick, shadow, and what that was the froth coming off of this rally. But this consolidation sideways has been very, very bullish. We are holding gains. So what we want to do is take our crayon out, draw our trend line up, and you can see here that we have some clear and defined resistance levels to get through before we're ready to say the bear market in natural gas is over. As far as I'm concerned right now, all we have is a cyclical bull market within the confines of a secular bear market. When does that end? That ends here. When we see natural gas rally and close above $38.94, then I'll be ready to say that we have a new bull market on our hands for the price of natural gas. Because what we'll have is a W formation and we'll have a close above the pivot point. So in short, what we'll be doing is that we'll be putting in a series of higher lows, and now on a higher level view, let's go back to that monthly chart, we'll also have a new higher high. That will set the stage for a new bull market on natural gas. Let's spend a moment talking about the daily chart. Hey folks, if you got this far and you've enjoyed the video and you'd like to see more videos from me, can I ask you to please click that subscribe button? We're trying to grow the channel a bit. Now let's move on to the remainder of my analysis. Thank you. Let's spend a moment talking about the daily chart of natural gas. And you can see that here's where we got overbought. On November the 14th, that's where we got short. We booked profits here on our short using the DGAZ. We popped up higher. The following days, we're seeing a lot of volatility. So this lower band of support is really no longer relevant because this uptrend was unsustainable. So what we want to do is update our chart and make our lower band of support more of a realistic lower band of support. Because what this was a massive short squeeze. And here's a more sustainable and defendable lower band of support. And that may even widen out itself in a few days. So what we're looking for here, were we to want to buy UNG as a momentum play, we need to see a close above $38 per share. If we rally up and through $38 per share, in all probability, we are going to again retest prior highs, and we will, in all probability, break out to new higher highs on natural gas. But would I buy right now? No. Why? The reason is that what you're seeing here is a lot of topping action on these candlesticks. Wicks, shadows, call them cupcakes. It doesn't matter. All it implies is that you have sellers above. They are selling strength. They did it as recently as yesterday, taking UNG off the highs of the day. It still had a very good day. It was up 10.5% on the day, but you're still seeing some sellers. So I wouldn't be a buyer until one of two things. One, a close above the upper band of resistance. Two, a pullback and a retest of the lower band of support. And if we got that retest of support, I would keep my buys small and then buy more on a rally up and through resistance. Volume yesterday was very strong. And for those worried about the US dollar, which is now coming under some pressure, and how it might affect UNG, it really has, unlike many other commodities, it has little impact. Why is that? It's because we produce so much natural gas here in North America to the point where we're now an exporter of natural gas, unlike oil, where we're still a net importer. The price of the US dollar, which is overlaid here in black, you can see that the two have been trading in tandem for quite a while now. So really no adverse impact of a stronger US dollar on natural gas. Now, when you take a look at the US dollar versus oil, here's the USO. Different story here. While oil has been able to still do well in most of 2018 with a stronger US dollar, that has ended. And as we broke out to new higher highs on the year, for the dollar, oil rolled over and broke down below key support levels, and we are now down 11.24% on oil, while the US dollar is up 7.62%. Now, I mentioned earlier that we had an extreme oversold stock that we were accumulating, and that trade is DLNG. DLNG is a master limited partnership. At current, we have RSI at 10.99. Extremely oversold, but it's down below $5 per share, so that means it can go down sub 10 on RSI. I wouldn't be the least bit surprised. Now, you may be saying, Bob, you're crazy, because they're going to come out any day and they're going to cut the dividend on DLNG. At current, it's posted here that it's yielding 28.74%. I hope they cut this dividend, because that's exactly what the market is expecting. And my bet is that we will rally on the news. So what we're looking for here is a continuation move lower and a bullish key reversal, and we will be adding aggressively to DLNG. And if you take a look at DLNG on an intraday basis, on a 2-hour basis, we have RSI at 8.33. But despite the fact that we are putting in lower lows on price, as noted here, you can see that we are putting in higher lows on both RSI and on Stokes, despite the fact that we are moving lower on price. So what does that imply? It implies that we have a divergence going on. We have RSI and Stokes, which are no longer validating, no longer confirming the downward pressure on DLNG. What I can conclude from that is that we have capitulation selling, and that the bottom is very close at hand for DLNG. And when you take a look at the ADX with signal line above 70, this downtrend is unsustainable, and we have the markets already sending us signals vis-a-vis higher lows that we are about to get a big rally in DLNG. So more to come. And that is it for my analysis of natural gas on a multi-period chart basis and DLNG. If you haven't currently subscribed to my YouTube channel, please do so. Leave me a comment, share with a friend. Everybody have a profitable trading day. Be well.